Common mistakes beginners make with index funds and how to avoid them. Detailed guide. Hello everyone and welcome back to the channel. If you have been following this series from the beginning, thank you for staying with us. In the previous videos, we covered what index funds and ETFs are, why most beginners should consider them, which specific funds are good choices in 2026, how to buy your first one, and how much you should invest. Today, in this longer video 7, we are going to talk about something extremely practical and important. The most common mistakes that beginners make when investing in index funds and ETFs, and exactly how to avoid them. Making mistakes is normal when you are learning something new. However, in investing, some mistakes can be very expensive and can set you back many years. The good news is that most of these mistakes are completely avoidable if you are aware of them and take the right steps. In this video, we will go through each common mistake in detail, explain why it happens, show the consequences, and give you clear solutions. As always, this video is for educational purposes only and is not financial advice. Please consider your own financial situation, goals, and risk tolerance before making any investment decisions. Let's begin. Mistake 1. Trying to time the market. One of the most common and costly mistakes beginners make is trying to time the market. This means waiting for the perfect moment to invest. For example, waiting until the market drops, or until economic news looks better, or until they feel more confident. The reality is that market timing is extremely difficult to do successfully, even for professional investors with teams of analysts. Studies have consistently shown that missing just a few of the best performing days in the market can dramatically reduce your long-term returns. For example, if you stayed invested in the S&P 500 from 2000 to 2020, but missed the 10 best days during that period, your returns would be significantly lower than if you had stayed invested the whole time. The problem is that those best days often come right after big drops, when most people are scared and sitting on the sidelines. Why do people try to time the market? It usually comes from fear and the desire to avoid losses. Many beginners feel that if they invest now and the market drops right after, they will have made a mistake. So they keep waiting for a better time. How to avoid this mistake? Instead of trying to time the market, use a strategy called dollar-cost averaging. This means investing a fixed amount of money at regular intervals, for example, every month or every paycheck, no matter what the market is doing. This approach removes a lot of emotion from the process and helps you automatically buy more shares when prices are low and fewer shares when prices are high. The most important thing is to start investing and stay consistent rather than waiting for the perfect moment. Mistake 2. Investing money you might need in the short term. Another very common mistake is putting money into index funds or ETFs that you might need within the next few years. Many beginners invest money that is meant for short-term goals, such as buying a car, paying for a wedding, making a down payment on a house, or handling emergencies. Index funds and ETFs are designed for long-term investing, typically 5 years or more, and ideally 10 years or longer. The stock market can go down significantly in the short term, and if you are forced to sell during a downturn, you can lose a substantial portion of your money. Real example. Imagine you invest $20,000 that you plan to use for a house down payment in 2 years. If the market drops 30% during that time and you have to sell, you would only have around $14,000 left, a $6,000 loss that could delay your plans. How to avoid this mistake? Build an emergency fund first before investing large amounts. Most experts recommend having 3 to 6 months of essential living expenses saved in a safe, easily accessible account, such as a high-yield savings account. Only invest money that you can comfortably leave invested for many years. Mistake 3. Not diversifying properly. Some beginners make the mistake of putting all their money into just 1 or 2 stocks, or into a very narrow sector such as only technology or only one country. While it is possible to get lucky with concentrated investments, it is also very risky. One of the biggest advantages of index funds and ETFs is instant diversification. However, some people still end up with portfolios that are not well diversified because they only buy funds that focus on a small part of the market. How to avoid this mistake? For most beginners, the simplest and safest approach is to use broad market funds. For example, VTI, Vanguard Total U.S. Stock Market ETF, gives you exposure to thousands of U.S. companies. VT, Vanguard Total World Stock ETF, gives you exposure to both U.S. and international markets in one fund. If you want to build a simple portfolio, using 2 to 3 broad, low-cost funds is usually enough for good diversification. Mistake 4. Chasing past performance. It is very common for beginners to look at which funds or sectors performed the best over the past year or past 5 years, and then invest heavily in those. This behavior is called chasing returns. The problem is that funds or sectors that performed very well recently often underperform in the following years. Markets rotate, and what was hot yesterday may not be hot tomorrow. Real example, many people heavily invested in technology stocks after they performed extremely well in certain years, only to see those same stocks underperform for several years afterward. How to avoid this mistake? Focus on low-cost, broad market index funds that have delivered solid long-term results, rather than chasing whatever performed best recently. Stick with your plan instead of constantly switching to the latest hot fund. Mistake 5. Ignoring fees and expense ratios. Many beginners do not pay enough attention to the fees they are paying. They focus only on returns and ignore how much they are giving away in annual fees. Even small differences in expense ratios can have a massive impact over 20 or 30 years due to the power of compounding. Paying 0.8% or 1% in fees every year instead of 0.05% can cost you tens of thousands of dollars over a long investment period. How to avoid this mistake? Always choose low-cost index funds and ETFs. Look for expense ratios below 0.10% whenever possible. Funds from Vanguard, Fidelity, and Schwab are often excellent low-cost options. Mistake 6. Panic selling during market declines. The stock market goes through periods of decline from time to time. These periods can be frightening, especially for new investors who have never experienced a big drop before. Many beginners panic and sell their investments when the market falls significantly. Selling during a downturn locks in your losses and often causes people to miss the recovery that usually follows. Historically, the market has always recovered from declines and gone on to reach new highs over the long term. How to avoid this mistake? Develop a long-term mindset. Remind yourself that market declines are normal and temporary. Continue investing regularly through dollar-cost averaging. Having a clear plan and understanding historical market behavior can help you stay calm during difficult times. Mistake 7. Overtrading and frequently changing investments. Some beginners get excited about investing and frequently buy and sell different funds, trying to find the best one or reacting to short-term news. This behavior is called overtrading. Constantly switching funds usually leads to higher costs, more taxes, emotional decision-making, and worse long-term performance. How to avoid this mistake? Once you have chosen good, low-cost, broad market funds that match your goals and risk tolerance, stick with them for the long term. You do not need to make frequent changes. A simple, consistent approach usually beats a complicated, frequently changing strategy. Mistake 8. Not starting early enough. Time is one of the most powerful factors in investing. The earlier you start, the more time your money has to grow through compounding. Many people delay investing because they feel they don't have enough money yet, or because they are waiting for the right time. Unfortunately, the longer you wait, the more potential growth you miss. Even small amounts invested early can grow into significant sums over decades. How to avoid this mistake? Start as early as you can, even if you can only invest a small amount each month. It is much better to start small and increase your contributions over time than to wait for a perfect moment that may never come. Mistake 9. Comparing yourself to others. Social media and online communities are full of people showing their investment gains and portfolios. It is very easy to feel like you are falling behind when you see others posting big returns or large portfolios. Comparing your journey to others can lead to poor decisions, such as taking on too much risk or feeling discouraged and giving up. How to avoid this mistake? Focus on your own goals and progress. Everyone has different starting points, income levels, expenses, and risk tolerance. What matters most is that you are consistently moving forward according to your own plan. Mistake 10. Not understanding taxes. Many beginners do not think about taxes when investing. Depending on the type of account you use, taxes can have a significant impact on your returns. For example, selling investments in a regular taxable brokerage account can trigger capital gains taxes. On the other hand, investing inside retirement accounts like a Roth IRA or traditional IRA can provide valuable tax advantages. How to avoid this mistake? Understand the difference between taxable accounts and tax-advantaged retirement accounts. Whenever possible, use retirement accounts for your long-term investing to reduce your overall tax burden. Final thoughts. Making mistakes is part of the learning process when you start investing. What matters most is that you learn from those mistakes and adjust your approach moving forward. Index funds and ETFs are relatively simple and beginner-friendly compared to trying to pick individual stocks. By avoiding the common mistakes we discussed in this video, such as trying to time the market, investing money you need soon, ignoring fees, panic selling, and comparing yourself to others, you greatly increase your chances of building real wealth over the long term. In the final video of this index fund series, we will look at a simple, practical example of how to build a beginner-friendly index fund portfolio from start to finish. If this detailed video about common mistakes has been helpful, please give it a like and subscribe to the channel. It really helps us continue creating this type of in-depth content. Leave a comment below and share which mistake you think is the most important to avoid, or which one you have personally experienced. What questions do you still have? Thank you very much for watching all the way through. I will see you in the final video of this series.